Hey, what's going on, everybody? Max here with BB, and today for 10 Minutes Max, we're going to be talking about Wednesday, Thursday, and Friday, which is jam-packed with economic data and meetings and everything that you guys probably don't want to focus on, but unfortunately does affect markets. We got FOMC Wednesday, we have initial jobless claims on Thursday, the day after, and then Friday, we have the U.S. unemployment report. Before we dive into the charts, guys, please do me a solid. Please consider liking the video and then also subscribing to the channel if you are new here. Again, we are almost at 20K, getting real close, and that's largely thanks to you guys liking the videos, subscribing to the channel, really helping us out. So we got a few things. I just took screenshots just so I wouldn't have to pull up another website. But this is basically this is what the market is pricing in regards to probabilities for interest rate policy here in the US, okay? So let's start here on the left real quick. We'll do a summary and then we'll get into some TA and levels and what I'm expecting, okay? So tomorrow is July 31st, all right? So basically for the July 31st meeting tomorrow, there is a 95.9, so we'll just say 96. There's a 96% chance that the Fed remains in a state of a pause, meaning there are no interest rate modifications, there's no hikes, and there's no cuts. All right, that's a good thing, and we're going to get into what that means and why that's a good thing. There's a very small chance, just over 4%, that we actually get a 25 basis point or a 1/4% reduction in the effective federal funds rate. Okay. It's very unlikely. The Fed typically doesn't like to surprise the market. I would be absolutely shocked if this did happen. And if we did get a surprise cut tomorrow, just know that if they cut rates tomorrow, that's horrible. Okay. Interest rate cuts in that context of a surprise rate cut is not a bullish thing. Okay. So we're going to get into that as well. Next, on Thursday, so the day after FOMC, where we get to hear from Powell and it's being priced in right now, there will be no interest rate policy changes. We are going to get initial jobless claims. How many people are actually filing for unemployment, right? It's expected that comes in at 235K, same as last time, all right? Then Friday, last day of the week, we have the U.S. unemployment rate. It was 4.1 last print. We're expecting 4.1 again. All right. That's fine. That's fine. We want that to happen. So let's hide these and let's talk about what that would be. Actually, I'm going to keep these. Well, let's do this. We're gonna hide these, and I'm gonna just kind of show you what typically happens, and we're gonna do a little refresher. So some of you guys have already seen this, but we're gonna do a little bit of a refresher. Okay. So here's SPX. Just think of this if you're only into crypto, just think of this as like this is the stock market. All right, when people are like, "Oh, how are stocks doing?" They're probably just talking about the S&P 500. Okay, now we're gonna put the effective federal funds rate down below. Actually, we will do a different one. We'll do Fed funds, a little bit more history. So here's the stock market. We'll put it in log mode just so we can see it a little bit better. And you can see pretty clearly, I'll mark out Fed pauses. Okay. Now this was a weird one, right? We had some like little adjustments and stuff, but here is the Fed pauses. Okay. So they hike interest rates and then we move sideways. And then you can see what happens. Okay. So I will do that for the current ones as well. We will keep it going here because I want to show you guys that don't follow this stuff that closely. And why should you? It's kind of boring. It only affects crypto once every few years, but it's going to begin to affect it quite a bit. I do think it did in 2022 certainly. Let's mark this. Let's finish marking this out. All right. Okay. So here is when we're supposed to get some cuts. All right, so as you can see, there's something pretty repetitive that happens every Fed cycle, okay? Um, they hike interest rates, and then we go into a Fed pause, and then once they start cutting rates, typically, this Fed pause rally, which we get every single time, typically once they actually start cutting rates is when things get nasty. Let me turn this magnet off. So as you can see clearly, they start cutting rates, aggressively, and look what happens to the market. Now, what a lot of people don't realize is that when they make these interest rate policy changes, There is a lead and a lag to both the hikes and the cuts. So the hikes that that you had, for example, over here are not really being felt until like over here, okay? And then the cuts that you have here are really not being felt until, over here. All right? There's a potential multi-year lag between these interest rate policy decisions. They take a while to work their way through the plumbing of the economy, okay? But what you can see here is when we're in a Fed pause, markets go up. When we're in cuts, markets typically trend down. All right, so let's keep it moving here. You can see here in this Fed pause, you can see that the market rallied pretty nicely. And then, of course, once we got cuts, you can see what that implied for the broader market. So here we go. Got some cuts and we nuked, right? Uh, so not great, not great. Here, I'll mark this up here as well. We're just going to go through some examples and then we're going to talk about what it potentially currently means. So here's another prime example, right? Market moves up during this pause quite nicely. Again, this was shorter than the last two. But what was interesting about this one is we actually moved up for a couple hundred days after the first couple cuts. This was in 2019. So market actually like moved up, right? So we'll kind of put this as like an orange zone, like caution, like we're into cuts, but the market is moving up, which can happen, right? Which can happen. And then we got our day of reckoning, right? So where are we at right now? All right, where are we at right now? Well, as you can see, we're kind of doing what we've always done, right? We have moved up handsomely while we are in a pause. And I will put this back up as a reminder, if we can find it. That's not the right one. That's not either. There we go. What's expected and being priced in right now is a 95% chance, 96% chance that we remain paused, which is bullish. But there's also an 84% chance that we actually get a cut at the September 18th meeting. All right. So let's remove this now. Keep marking this up. I have this marked out. So is it possible that, similarly to stuff over here, like, in the 90s and 2007, 2008, basically we go risk off as soon as we get our first cut? Is that where we're at? Or is it going to be more like a 2019 situation where we actually rallied throughout the pause and then equities remained strong for 225 days until we saw a big correction? Well, I don't really know, right? But there's some additional pieces of this puzzle that we need to talk about, right? We need to talk about like how, because we want to stay bullish, right? Like we're looking for reasons to stay bullish. So we're going to talk about some of these other reports and kind of bring it full circle, okay? So additionally, on top of FOMC, which interest rate policy alone is not enough to send the market up or down. Well, that's not necessarily true, right? Interest rate policy by itself is not enough, like as a standalone, right? You have to contextualize the decisions. Why did we hike? Why did we cut, right? We were hiking, all throughout 2022 because we printed a lot of money because of COVID and we had record high, CPI. We had like 9% CPI, right? Horrible. So we hiked interest rates to combat that. Why would we cut interest rates? We would potentially cut interest rates because all of the hikes from 2022 are now working their way through the plumbing of our economy, putting pressure on the economy, putting pressure on individuals, families, corporations, small businesses, big businesses. They are beginning to feel that. So we would potentially cut interest rates here in the U.S. to get in front of that and alleviate a lot of that pressure. Okay, and it will take a while, but again, you have to cut eventually to get through a recession, get through a pullback, and then eventually feel a little bit of relief, right? It's just these cycles. They play over and over and over again, as we just talked about. But here's the thing. Like I mentioned, rate hikes or rate cuts, they are leading and they're lagging. And without the proper context, it's not enough to just be super bullish or super bearish as a standalone decision, okay? If they cut tomorrow, like I said, which is not being priced in, I'll put this back up on the chart. There is right now the market is pricing in a 4% chance that we get a cut tomorrow. If they cut tomorrow, the market would interpret that as, oh no, something broke and the Fed knows about it, and they are trying to get as far in front of this problem as they can and get interest rate cuts working their way through the plumbing and the pipes of our economy as quick as they possibly can. The market would nuke. That would not be a bullish case. Everybody likes to think, oh, lower interest rates, that's bullish. No, it can be with the proper context, and we're going to talk about what that would look like. But with the backdrop of tomorrow's meeting and where we're at within this Fed cycle, if they surprise cut when we're not supposed to get a cut for, 50 days, that would be super bearish. Sell everything if they cut tomorrow. That's not good. Okay. If they cut in September, September 18th, and these two reports here, initial jobless claims and unemployment, don't signal a major problem for us, then I think we can get a 2019 style Fed cycle where we actually, we rally basically through the entirety of the pause, little local corrections, who cares? And then, we basically rally like after a couple 25 basis point cuts. And I'm gonna show up on another chart here. So let's look at jobless claims. All right. So here's initial jobless claims, people filing for unemployment. Right here in the bottom, I'll put this in, we'll just put this in blue. All right. So when you have a situation where you are getting interest rate cuts, and that's compounded at the same time with people and the job market remaining resilient, you can continue to rally. So let's take a look at this here. All right, I'm going to put this in red now, actually. So Fed cut happened here. All right, it happened in the middle of summer 2019, marked by this red line. You can see here they started to drop interest rates, but the market continued to rally. Why is that? If you look at initial jobless claims, you can see that it was moving sideways, right? It was moving sideways. I'll just draw it as like a square. This entire time right here. People were not filing for unemployment. So we had, and I'll go down to the lower time frames here, we'll get a better look at it. What we had was lowering interest rates, right? Marked by, this, you can see the effective federal funds rate. They were dropping interest rates. We know that's kind of a caution sign, so we put this in yellow, right? But it was coupled with a strong labor market. People weren't filing for unemployment. We had a small little spike here, but it sold right back off. We continued to, chop and grind. And then we had COVID, right? So black swan. Who knows what would have happened if we didn't have COVID and people just, unemployment just remained at record lows, right? And people weren't filing for unemployment, right? So that's a scenario in which, we could see a rally off of the back of these Fed interest rate cuts. Is as long as the labor market doesn't give out and people still have jobs, the market will remain strong in bid, because then that's bullish. Then it's more like bullish mean reversion interest rate cuts rather than we need to cut because something broke, right? So let's go over here now and look at here. Let's look at like 2008, right? So you can see right as we're starting to cut, you're seeing initial claims like spiking, right? And similarly to over here in the dot-com bubble, they start cutting rates, and look at initial claims is curling up as well. Where in 2019, we didn't have that. We had initial claims floored until, of course, the entire world economy shut down. We saw that giant spike. And that chart will look just like the unemployment rate. So let's look at the unemployment rate now. They're slightly different, but basically the same, okay? So now this is, we'll put this in purple. This is this is U.S. unemployment rate. So yeah, you can see here that leading into these cuts right here, they start cutting midsummer 2019. Market continues to rally because we still have unemployment in the U.S. floored and plateaued. Let's go back and we'll look at a bad example of this. All right, look what happened here in 2007. Look at what happened when U.S. unemployment began to climb above 5%. So it cracks 5% right here. We're into cuts, markets distributing, unemployment spikes. Clearly goes above like what, 9%, 10%, almost 10%. Market sells off. They're cutting rates because they can see the labor market deteriorating, right? Same thing over here, dot-com crash, unemployment climbing up, 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 up. They're cutting rates, right? So what we want to see is unemployment plateau. We want initial jobless claims, and we want unemployment to plateau, and then we can get a 2019 style 2019 style cut. So what's expected? What is expected? Last print was at 4-1. They're expecting 4-1 again. This is the bullish scenario, all right? Let me give you the bullish scenario. Again, I will just draw it out for you, okay? Similar to 2019, what you're going to want to see is the market should rally, okay? It should continue to rally at least through September. It would be very strange, something we haven't seen before, the market high time frame correcting before we get into cuts, okay? It usually happens right at the cuts or within a couple hundred days after, okay? So rally into the cuts, maybe a little pullback, another stair step down after we get the first cut, and then you'd want to see it just continue to like grind up like this, okay? Just like this. And what we would need to see right here is basically unemployment kind of just like moving sideways like this. We would just kind of need to see it like, doing this between 4 and 4.25 or something like that. All right. That would be your bullish case. All right. So if US unemployment stays where it was, and basically it's been between 3.8 and looks like 4.1 for, a couple years now. US unemployment remains floored just like it did over here in 2019 when we got our cuts. Then I think we can get this kind of yellow zone here where even though we're in Fed cuts and that something eventually is going to, mean revert, you can kind of have like an additional cut melt up, right? And then eventually, once we're into, let's do it, it'll look like this. So here's like 125 basis point cut. Here's another one, it looks something like this, right? Maybe we move sideways and hold for a bit. Then, maybe sometime over here in 2025, we get like a bigger, high time frame correction and they have to like really cut rates. I don't know if it'd go to zero. We'll take it one meeting at a time, right? But kind of shorter term, this is your bull case, right? Is like you need these prints this week. Like they are so important, guys. Like I can't emphasize enough how important these prints are. Like I can't emphasize enough, like we need to see bullish prints across the board. Like you need us to stay paused, which I think is very likely tomorrow. Okay, so we need to stay paused right down here, 525 to 550. If they cut tomorrow, just sell everything immediately. Don't even log on. Don't check my Twitter. Don't check YouTube. If they surprise cut tomorrow, like it's not good. Okay, I don't think that's gonna happen. I'm just letting you know. Okay, I think that would be bad unless they attach some additional context to it that I don't have that information yet. But. Additionally, even more important is initial jobless claims and U.S. unemployment rate. Okay. We need the labor market to remain strong so that when they cut, we can still grind up just like we did in 2019. Today, thanks so much for being here. Before you go, please consider liking and also subscribing if you haven't yet. Last but not least, check out the links in the description below. First link take you to our website where you can sign up for our Discord. Right now, what you could expect is over 2 hours a day of private live voice calls with me and the entire BB team and community. Additionally, within the next few weeks, you're going to get free access included in that membership to our new flagship product called the BB Terminal. It's got portfolio tracking, derivatives data, heat maps, high time frame DCA indicators, literally everything that you could need or want to succeed in markets. So couple that with the actual the voice chats and the calls and the transparency. We share all of our positions and analysis, things we don't talk about publicly in the Discord. There's no better product out there, guys. That's the first link in the description below. Second link in the description below is to the BB Academy, guys. If you want to speed run your educational journey towards understanding these markets from a technical and fundamental perspective, we have taken the time. It took us about 6 months to compile what we would consider to be the best trading course in the entire internet. It's pretty awesome, guys. It's got me and the entire BB teams, all of our personal strategies that we have accrued over decades cumulatively of successfully trading in these markets. Again, there's a lot of people out there teaching TA. A lot of guys do it great. Some for free, some paid. We can teach you the right stuff. Don't learn the wrong stuff. So again, we do a lot of content for free, but if you really want to speed run understanding these markets, how to trade, definitely consider checking out the second link in the description below to the BB Academy. Guys, thanks so much for being here. This was 10 Minutes Max brought to you by BB, and we will see you tomorrow. Take care.